I will now like to review exercise 811. Tracy Company, a manufacturer of air conditioners, sold 100 units to Thomas Company on November 17, 2021. The units have a price of $500 each, but Thomas was given a 30% discount. The terms of the sale was $210 net 30. Thomas uses a perpetual inventory system. Prepare the journal entries to record the purchase by Thomas on November 17th and payment on November 26th is requirement 1. And we're using the net method. We're using the gross method in requirement 1. So we have to reduce the unit price to include the trade discount, which is 30%. So we would take 500 times 70%, which is $350 per unit times 100 units. So inventory would be debited for $35,000 and accounts payable would be debited for $35,000. Because they paid within the discount period on November 26th, we would debit accounts payable for what we originally credited the purchase on November 17th, which is $35,000. We were going to pay cash of 98%, which is a credit to cash for $34,300, and inventory would be reduced by 2%, which would be a credit to inventory of $700. Now, in requirement 2, they ask us to prepare the journal entry for payment, assuming instead that it was made on December 15th, 30 days later. They are not eligible for the discount, and consequently, they have to pay the full amount, which would be a debit to accounts payable and a credit to cash. Now in requirement 3, they ask us to go back and redo requirement 1 and 2 using the net method. So on the purchase date, Thomas Company will debit inventory at 98% of $35,000, which would be $34,300 debit, and a credit to accounts payable, $34,300. And on November 26th, they paid it within the discount period, so they just have to debit accounts payable for the $34,300, which was what was established as the accounts payable on the purchase date, and credit cash of $34,300. In requirement 2, they ask us to prepare the journal entry for the payment, assuming instead it was made December 15th. Well, in December 15th, they'd have to remove the original purchase accounts payable, which was $34,300, but they had to pay cash of $35,000 because it was not paid within the discount period. So therefore, we have to debit an account called purchase discount loss for the $700. Now note, if this was all done using the perpetual method. So if we had to use the periodic method, inventory journal entries, debits or credits, would be replaced with the purchase account, and if there was a purchase discount loss recorded in a perpetual inventory, the actual account used under the periodic inventory would be purchase discount